Hello and welcome back to Dukascopy TV. I'm Monica Gibson and I'm joined in the studio by Bruno Estier. Together we'll be looking at the market review from a technical perspective. Bruno, thank you very much for coming in today.
Hello Monica.
So we've looked at the S&P 500 in the past in our previous sessions and we were forecasting a bit of a rebound on the cards. What is your analysis at the moment? What is your perspective and what are the charts showing us?
To have an idea about what the S&P, we need to look at a measure of sentiment. The famous measure of sentiment is the VIX. The VIX is a measure of fear. Why? Because portfolio managers, which are usually long equities, will buy put options when they think things are getting hot for their portfolio. That means when they fear a corrections. To do that, they are going to bid up the price of volatility which goes into the formula of put options. And we have that here on display on a weekly basis since 2011. We have a lot of lines here. First of all, at the top part, we have in orange the S&P 500 and the Euro stocks value, the Euro dollar value, excuse me. On the middle charts, we have the value of VIX. And for example, during the correction of 2011, when people were speaking about Greece, for example, you had a spike up to 46%. Now, there is just one level we need to remember to know the difference between normal time and exceptional time. Normal time is when the VIX is below 20. That's why I call that the magic level 20. And above that, usually you have a rising fear in the market. Now, we could of course look at measure of momentum for the VIX. If it's going down, if it's going down faster, if it's moving up. And recently it has been moving up a little bit from the level of 12%, which is well below 20%, and is rising toward 20%. Now, on a weekly basis, that means that there are fear growing in the market. And in fact, during the month of May, some of the market makers were already protecting themselves and already bidding up the VIX from 12 to 15, 16 and so on. And recently it made a little spike above 20 that we can see on the daily charts, on the next charts.
Okay. It
made the spikes above 20 just at 21, namely last Monday when everybody was kind of fearing that the market, the S&P would go below 1560. And there it rebounded. We discussed last time that probably it rebounded because interest rates reached a very high peak at 266, and that was a good value level for bond manager to buy it back. And we looked at the correlation, and therefore we are not surprised that the VIX did not stay above 21% because also the S&P rebounded. So when the S&P rebound, the fear diminished, and you see that in the VIX moving below 20%. Now it has moved towards 17%, but it's not yet really in a downtrend. It is kind of a neutral range between 15 and 20. And if it stays there for the next 3 or 4 weeks during the summer, that will probably be a sign that on the one hand the S&P can move up, and we are going to see that. On the other hand, that there might be some surprise in the fall still. It will still be opened. The market makers are not going to offer cheap insurance protection at 10% levels probably during this summer.
Very interesting.
The next chart is what we can see on the S&P on the weekly part. We notice that we have already made a beginning of a correction. It is a rebound. And as the momentum is still down, the question is the rebound going to move very high or just a little bit high? And we see that on the daily charts, on the next chart, which shows, here we have again our lovely cloud charts, which we broke through below it. That was on the 24th of June. And there the fear was at the maximum. And if we see now a week later on the next chart, we see that it rebounded nicely and went almost into the cloud. So we are in kind of an equilibrium place now. The bulls and the bear are at the same level. Nobody has the upper hand. And the question now for other markets than the S&P is to figure out basically, are other markets than the S&P going to rebound, because they were declining more than the S&P. The emerging markets were declining more, the Euro stocks market were declining more. And we see that on this chart of the Euro stocks, where we have also on the dotted line, on the top line, this dotted line which is showing the relative strength of the Euro stocks compared to the S&P. That means when the Euro stocks is moving down, is it going down more than the S&P? Yes, when that line is going down. And no, of course, when that line is moving up. If we look at the daily charts to picture the recent movement, we are going to realize that in the last move down to the end of June, we had also this dotted line slightly moving down again. So it is usual correlation. That means that the European market are viewed from American investor as high beta. That means they move more on the downside than the American markets. The rebound also took place, but we notice also a gap. A gap is a place where there is no price, which is around 26.60, and we're still below that. For the European market, as long as we're below that level, the risks remains more of a sideways market and less of a rebound. And the rebound will be possible only if we move above this 26.60 area. And even given the long-term charts on the Eurostock, it is not certain that we'll be able to see the highs of 28.50 again before the fall. In the fall.
I know there's obviously quite a lot of different benchmark prices that we're looking for there, but Bruno, thank you very much for coming in and talking us through and giving us another update. It's been very interesting once more.
You're welcome.
Thank you. Well, that's all from Bruno and myself. Don't forget we have MGT in the studio later on, so please do click back for that.